Reading 10 of the CFA text, Estate Planning in a Global Context. Estate planning is a multidisciplinary endeavor that involves the intersection of tax, law, and finance, and understanding the primary legal and tax financial issues can help effectively create tax alpha. Assets in estates can have ownership transferred by virtue of ownership, a will, or trust. By that, where it says by virtue of ownership would be sole ownership versus joint. You could also transfer it with a will or transfer it with a trust. Probate is the process by which a will is validated and can be relied on by interested parties. A country's legal system can limit the freedom of a testator to dispose of assets as he or she sees fit, or it could give forced heirship, community property, etc. Two primary ways of transferring ownership of assets are lifetime gratuitous gifts, which are called gifts, lifetime gratuitous transfers, think gifts, and testamentary gratuitous transfers, think bequests. Bequests are after death. A wealth transfer strategy involves estimating an individual or family's core capital and excess capital. Core capital is the amount of capital required to maintain a given lifestyle and provide adequate reserves for unexpected commitments, and can be estimated using mortality tables or Monte Carlo analysis. Excess capital represents assets above and beyond core capital that can be safely transferred without jeopardizing the first generation's lifestyle. Tax-free gifts that fall below periodic or lifetime allowances can be an effective means of minimizing estate tax, especially if a gifting program is developed early. Opportunities for tax-efficient gifting programs also exist when lifetime gifts are taxed, especially when the gift tax is paid by the donor rather than the recipient. Transferring capital in excess of a second generation's need for spending, safety, flexibility is directly given to the third generation or beyond, which are generation skipping gifts, and can help minimize taxes where permitted. As in, if the third generation is going to get it anyway, in some senses it makes sense to not give it to the second generation. Transferring capital in excess of second generation spending. Taxpayers in jurisdictions with both spousal exemptions and exclusions for smaller estates in effect have two estate exclusions available, one for each spouse. Tax efficiencies are possible using valuation discounts and charitable gratuitous transfer strategies. Common estate planning tools include trust, foundations, insurance, and companies, each of which can provide benefits related to the asset control, protection from creditors, and taxation. The control and protection trusts offer, whether structured as revocable or irrevocable trusts, can provide flexibility as well as legal validity. Families with an international footprint face special issues relating to the drafting and recognition of legal documents such as wills and trusts. The taxing authority of the country is determined by its tax system, which would be versus residence tax system, and may conflict with the taxing authority of the other country. Jurisdictional claims based on source or residency can conflict with source jurisdictions, typically given primacy. Source jurisdictions are typically given primacy. Double taxation conflicts can be resolved through either foreign tax credit provisions of the home country or double tax treaties with other countries. The ability of locating undeclared funds in offshore savings accounts and other offshore structures to avoid detection by home country taxing authorities is being eroded by trends towards an increase in information exchange and transparency across countries. Compliant, tailored, tax-efficient strategies are key to meet the needs and objectives of clients and their successor generations.